Okay, everyone, welcome back to our ACCA lecture. I'm James, and today is the very last day for our F8 audit, and we're going to talk about Chapter 11, Completion and Review, and Chapter 12, Reporting. Chapter 11, Completion and Review. This is the very last stage before we can issue our audit report. And before we sign off our audit report, we're gonna finalize a few procedures. We're gonna review the subsequent events. We will evaluate the misstatements individually and aggressively. And we're going to review the going concern. We will take a final analytical procedures, and we're going to obtain the written representations from the management. So first of all, the subsequent events. A subsequent event is an event occurring between the date of financial statement, which is basically the end of the year, but some company would like to choose the end of March or the other end of any month. So and the date of the auditor's report. So between that period, the facts that become known to the auditor after would become a subsequent event. So ISA 560 subsequent events, it's saying that as an auditor, we have to obtain sufficient and appropriate audit evidence about whether events occurring between the date of the financial statement and the date of auditor's report that require adjustment or disclosure are appropriately reflected, right? And we have to respond to the facts that become known to the auditor after the date of auditor's report. And the IAS 10 events after the reporting period identifies two types of events, right? And for adjusting events, which means we're gonna have to change our financial statement in numbers. We have to adjust the financial result. If it's material, we're gonna adjust that. And the other type of events are non-adjusting. So for those material events, as it's non-adjusting, so we're gonna disclose that, right? So what is adjusting events? That kind of events existed at the end of the year. So that would be the fundamental difference between a adjusting event and then a non-adjusting event. Right? So these events that provide additional evidence relating to conditions existing at the reporting date. Right? And such events provide new information about items included in the FS, and hence the FS should be adjusted to reflect the new information. So examples would be allowance for damaged inventory and doubtful receivables, right? Or amounts received or receivable in respect of insurance claims, which were being negotiated at the reporting date. Or the determination of purchase or sale price of non-current assets purchased or sold before the year end. So those events existed before the end of the year, right? So it's part of our financial statement. it's just that the new evidence or new information became to known to auditor, right? After the year end. So, and other examples would be the agreement of a tax liability, discovery of errors or fraud, revealing that the FS are incorrected. So for the events occurred in the period between the date of financial statement and the date of auditor's report, can give us more information and make us correct or adjust our financial statement and make it more reflected, better reflected our financial results. Right? And for non-adjusting events, these are events concerning conditions which arose after the reporting date, and if it's material, we're going to disclose that. So it is not an event existed at the end of the year, but it is after the end of the year, right? But if it's material, we're still going to disclose it, because although there's a few months past, but the disclose of these non-adjusting events would highly help intended user to understand the most updated situation of that entity, right? So examples of non-adjusting events include issue of new share or loan capital, major changes in the composition of the group, M&A, right? And losses of non-current assets or inventory as a result of fires or floods, or floods, and strikes, government actions such as nationalization, so and purchase or sales of significant non-current assets. For those non-adjusting events, although they are not existed by the end of the year, but those events are material, and we should disclose that. Right? So that would be the subsequent events. And to be specific, for example, by the end of 2019, this would be our year end. And before our financial statement got finally approved, the pandemic happened, right? The pandemic occurred. So that would be a non-adjusting events, because that pandemic doesn't exist by the end of 2019, right? So that means the pandemic would be a non-adjusting event, but the effect of the pandemic would be very material, and including the controls of activities and the related control measured by the government, right? And the global spread of the pandemic. So that would be a non-adjusting event, but it is too material so that we should disclose that. Right? So in the case of non-adjusting events, entities need to consider the impact of the non-adjusting event on the financial statement. If the impact is material, the entity should disclose the nature of the events and its estimated financial effect, or a statement that such an estimate cannot be made because we don't have the reliable information, or we don't have an estimation about that impact, right? So anyway, you should disclose the nature and effect, right? And for example, if there's a there's a bankruptcy of a customer that caused purely by the pandemic, right? in that case, there is no evidence of existing credit issue by the end of the reporting date. So that means by the end of the year end, the credit of the customer is fine, right? But after the year end and until the pandemic take place, the credit goes down until and which caused the bankruptcy of the customer. So that in that case, it is a non-adjusting event because the credit issue doesn't exist by the end of the last year, by the end of the year end, right? But it happened purely because of the pandemic, right? So that would be the example of the non-adjusting issue, non-adjusting events. Right? And we have 3 periods. Period 1 is between the year-end date, which is your year-end, between the year-end and auditor's report gets signed. And period number 2 is between the report signed and the financial statement issued to the public or to the users. And period number 3 is after the financial statement released or issued to the users. So there are 3 kind of periods, and during the different periods, we have different responsibility for auditors. Period 1 is between the year-end date and auditor's report signed. Right? During this period, the audit report has not been finalized, so it is an active duty for auditors to perform procedures to ensure subsequent events have been accounted for appropriately. So that is in the middle of the audit, and audit report has not been signed. So auditors should actively look for evidence, look for the information of the subsequent event. That would be an active duty. Right? So between the date of this period, auditors should perform procedures to identify events that might require adjustment or disclosure in the financial statements. And if material adjusting events are not adjusted for, or material non-adjusting events are not disclosed, then auditor will ask management to make necessary amendments to the financial statement, which means that auditor should ask the management to modify, to adjust the financial statement, or put the disclosure of that event in the notes or in the financial statement report, right? And if the identified adjustments or disclosures necessary are not made, then the auditor should consider the impact on the auditor's report and whether a modification to their opinion is necessary. So that means maybe the management doesn't want to adjust the financial statement, and maybe they don't want to disclose that information, so that auditors have no choice but to change their opinion of the financial statement. Right? And subsequent events during this period, the auditors have that active duty, right? So we should take procedures to identify the subsequent event, such as we inquire of management if they are aware of any events, adjusting or non-adjusting, that have not yet been included or disclosed in the financial statement. We inquire into management procedures or system for the identification of events after the reporting period. We read the minutes of members and directors' meetings. We review accounting records and including the budget, forecast, cash flow, management accounts, and interim information. So we actively look for the evidence and information during that period, right? And we obtain a written representation from management confirming that they have informed the auditor of all the events, and they know they probably accounted for in the financial statement. And we inspect of correspondence with legal advisors if there's any settlement or any claims of the lawsuit. Right? And we review the progress of known risk area and contingencies. We consider relevant information which has come to the auditor's attention from source outside the entity, including the public knowledge, competitors, suppliers, customers, the news of the industry. So there could be any kind of outside information. Right? And we inspect after-date receipts from receivables. We inspect the cash book after year end, and that might not be accrued for at the year end. Right? So that will be those subsequent events. And we inspecting the sales price of inventory after year end. So that will be the NRV, and we would have an evidence on whether the inventory is correctly measured, right? If NRV is lower than our book value, then we should accrue the allowance for inventory, right? So those are the procedures we should take to get the information about the subsequent event, right? And those subsequent events and those procedures would highly help us to know more about what is happening by the end of the year, right? Because there are more information became to known during the few months after the year end, right? And that would give us a more clear picture on what it looks like by the end of the year. And period number 2 is between auditor's report gets signed off and final statement issued. So during that period, auditors have a passive duty, because we have no obligation to perform procedures, but must take action if they become aware of events which would cause a modified opinion. So we are passively take those information, and if there is any kind of information or events became known, and we would like to consider that as a material events, and maybe the financial statement might be modified because of that, then we will take action, right? So between this period, the auditor is under no obligation to perform any audit procedure. We just passively heard of it, we passively be aware of it, or we might be informed, but it's passive, right? And if they become aware of a fact that would cause them to amend the auditor's report, they must take action. Right? And if management do not amend the financial statement and the auditor's report has not yet been issued to the client, the auditor can still modify the opinion. Right? Because during this period, although the auditor's report has been signed off, but the intended user haven't received that, and it's not publicly released yet. So the auditor can take back the audit report and modify it, right? Because it's still between the client and the auditor. So any third party hasn't been aware of the content of the audit report. So we're still in time, right? So if the auditor's report has been provided to the client, then the auditor should notify management and those charged with government not to issue the financial statement before the amendments are made, right? So maybe at this point of time, the audit report is in the hand of your client's management, but they haven't issue it to the shareholder, to the public yet, but it's still on the hand of your client. And then you have to notify your client, I would like to take back my audit report and modify it, right? So if the client issues the financial statement despite being requested not to do so, so maybe your client really like this report, and which is a clean report, an unqualified report, so they are insist to release that report, which is not correct, right? But in this way, auditors should take action to prevent reliance on auditor's report and ask for a legal advice, right? So that will be the second period. During this period, auditors only have passive duty, and the report is still it's still between the auditor and the client, so hasn't been issued to the public yet, right? So this is still fine. But period 3, after the financial statement are issued, so that would be tough, right? So the auditor is under no obligation to perform audit procedures as well, unless they become aware of a fact which should be cause them to amend the auditor's report. They must take action. So in this case, auditors should discuss the matter with management and consider if the FS require amendment. So auditors should perform audit procedures on the amendments to ensure they have been put through correctly. And auditors should review the stamps taken by management to ensure anyone who is in receipt of the previously issued FS is informed. So that will be a recall, and that will be a callback of the financial statement, right? Although it doesn't look good, right? But the public, the intended user, would understand, because there is a subsequent event that is not a fault of auditor. It is purely because of the new information, right? So hopefully everyone would understand, but we're gonna call back the audit report, and then we're gonna issue a new auditor's report, including the emphasize of matter or other matter paragraph to draw attention to the fact that the FS has been reissued. This is a replaced addition, right? So if management refuse to recall and amend the FS, that means they really don't want that subsequent event to be reflected on the statement, on the financial statement. So in that way, we should take action to prevent the reliance on the auditor's report, right? We can ask for legal advice. We can publicly announce that the previous audit report should be called back. So we will issue please pay attention to the reissued audit report. Right? And here's an example. We have 4 scenarios. Scenario number 1, on January the 2nd, the client had a major customer, right? And that customer was placed into administration, which means that they're gonna bankrupt, right? They're gonna there is a liquidation of that client. So and that amount is material, right? So that amount the customer owes our client is $211,000 in dollars, which is 20% of profit, and that is material, and that is an adjusting event because the credit issue is not caused by a subsequent event. It's already existed by the end of the year. It is just we didn't know until until now, right? So that is an adjusting event, and that is material. So that is why we should write off, we should adjust our financial statement, right? And scenario number 2 is that on January the 3rd, one of the sales director left the company, but this guy is suing the client for constructive dismissal. And he is claiming amounts to $280,000, which, comparing with the profit, this amount is material. However, this is not an adjusting, right? Because the sales director left the company after the end of our reporting period, right? After the end of the year. So it happens in the next year. So it's not exist by the end of the year. So it's a non-adjusting, but it is material. That is why we should disclose that event, right? And scenario number 3, on February the 5th, there is a fire at the premise of the third-party warehouse. So it's a fire, right? It doesn't exist by the end of the year. So it's a non-adjusting event. But the potential damage would be as high as $1 million. So that means it is material. So non-adjusting event, which is material, and in that way, we should disclose that event. Scenario number 4, the financial statement include a $40,000 provision for a unfair dismissal case. Right? So and bought by an ex-employee, and on February, the settlement would be $25,000, right? And it is likely the company will agree to this. So that dismissal case existed before the end of the year. It is just the number became clear on as the settlement out of the court. Right? So it is an adjustment, but it's not material because the amount of adjustment is the difference between 40,000 and 25,000. It's just 15,000, which is 1.43% of profit. So it's not material, and although it's an adjusted event, but we don't have to do any adjustment, right? It's not material. So this is an example for our subsequent events. And another example, we have another case, and we were required to explain whether the two outstanding issues are adjusting or non-adjusting. And we were required to describe appropriate audit procedures, and we were required to take further action when the directors refuse to adjust or refuse to disclose the subsequent event. Right? So for the legal claim is an adjustment event because in our case, the condition exists at the end of the reporting period. Right? And the legal claim is material because although we are compensating the teenager on a yearly basis, but let's say there is 40 years more lives for this person. So that means a lot of money, which is maybe $4 million, and that makes this event material. So adjusting events and material. So for this kind of events, we got adjust our financial statement. And for the proposed dividend, it happened after the end of the year, because the shareholders would like to, the board meeting decided to distribute a dividend in after the end of the year, right? So it happened after the end of the year. And although it is material, but it's a non-adjusting event. So in this case, we are gonna disclose the event because it is material, but it's a non-adjusting event. So that will be our propose, and we should take audit procedures on the two cases. For the legal claim, we're going to review legal correspondence in order to understand the likely outcome of the legal claim, right? Because for legal claim, it could be a contingent liability, it could be a provision. It's based on the probability of the outcome. And we're going to review customer correspondence and legal file in order to identify other similar claims which could give rise to additional liabilities. And we will discuss with the production director the likely cause of the burns, and to determine the likelihood of any claims being successful in court, right? And we're going to review the trade or consumer price, the third-party information, to identify whether the claim might damage or the reputation of the client, which would impact future revenue or event, or even create an ongoing concern rate. And we will propose adjustment of financial statement to the directors. Right? So that will be a regular process for a legal claim. And for the proposed dividend, we will re-inspect the board minutes in order to confirm the amount of the proposed dividend. And we propose an adjustment to the financial statement to remove the dividend from being recognized in the financial statement, because it should not be part of the FS by the end of the year, because it happened after that, and we should disclose that. So the impact on audit opinion will be that the auditor must modify the audit opinion if the director refuses to make the adjustment. Right? So both the legal claim and the proposed dividend, both the two cases here are material, right? RMM. An auditor must express a qualified opinion because it's material but not pervasive. Right? And auditor must express an adverse opinion if it's material and pervasive. And given the size of the amount, a adverse opinion might be appropriate in our example, right? Because the amount is huge. And so in this way, we are issuing a qualified opinion. So that means we should change the wordings in the audit report. The basis for opinion section will be amended to a basis for adverse or basis for qualified opinion. And because our client is a listed company, so we might add the KAM paragraph to reference the base for adverse or qualified opinion section. Right? We should add the KAM paragraph. So the going concern concept, it's we're gonna review the going concern, right, by the very last stage of the audit, and before we can sign off our audit report. We should look back, and then we can having that evaluations on whether the client has a going concern issue. Right? If the going concern issue is material, then the client should not prepare the financial statement on the base of IFRS, because IFRS is a going concern based framework. Right? If the customer, the client, has that going concern issue, then the client should not prepare the financial statement based on IFRS. So going concern is the assumption that the entity will continue in business for the foreseeable future. Let's say 12 months, the minimum, right? So the period that management is required to consider is the period required by the applicable financial reporting framework, or by law or regulation if longer. And generally speaking, the period is a minimum of 12 months from the year end. But in UK or some other jurisdictions, the period is a minimum of 12 months from the date of financial statement approved. So that means the 12 months begins maybe from April or March. So that will be UK or some other jurisdiction. And considerations of the foreseeable future involves making an adjustment about future events, which are inherently uncertain. So that would be a forecast, a foreseeable future. So uncertainty increases with time, and judgments can only be made on the basis of information available at any time. And subsequent events can overturn that judgment. So maybe we have a forecast in January, but in March there is a subsequent event happened, and that brings us new information about the going concern or about the cash flow of the next 12 months. So we should overrun that forecast to reflect the new information. So that means at any point. So it's a dynamic, it's an up-to-date forecast, right? So the going concern concept, whether or not a company can be classed as a going concern, affects how its financial statements are prepared, right? So that is why a going concern matters. If it's a company can only use a going concern base of accounting unless the manager either intend to liquidate the entity or cease trading, or has no realistic alternative but to do so. So that means they don't have the resources to run the business, right? They're running out of cash, and they don't have any resources to finance. And so why going concern matters? Because IFRS is based on going concern. If a company cannot exist in the next 12 months, then they should use a break-up base, use different base, right? So the basis for preparation and the reason why the entity is not regarded as going concern should be disclosed. So in a break-up base, assets are recorded at a sales value. It's not a book value. It's a sales value or market value. And inventory and receivables is not a book value. It will be written down to the lower price or maybe scrap price. And receivables may not pay if they know company is ceasing to trade. So that means a lot of the values on your financial statement would goes down, right, to reflect the marketable value or disposed value, and that would highly change the way we evaluate evaluate those assets and the liability, right? And for liability, in a breakup situation, additional liability might arise, right? Because there might be a redundancy cost for staff and cost for closing down the facilities, and maybe you're going to hiring an administrator, right, to handle the liquidation. So that would be an extra liability. So in this way, it's not IFRS, right? It's not IFRS at all, and it's a breakup basis. So that is why a going concern matters, right? So the responsibility for going concern goes to different roles. Director's responsibility would be that it is the director's responsibility to assess the company's ability to continue as a going concern. So they should have some kind of forecast, a business plan, which should be based on the right assumption, reasonable assumptions. So they should, it is the management who should assess that going concern ability. And in order to do so, the director should prepare a forecast at least 12 months in the next. And if they are aware of any material uncertainties, they should disclose that. And when the director are performing their assessment, they should take into account a number of relevant factors, such as the current and expected profitability, the debt repayment, a source of financing. So those factors would highly affect the the cash flow, or would determine whether the company can stay in the business in the next 12 months. So if the company has had a big loss, or had a huge amount of debt to be repaid in the near term, or they have running out of any additional resources of financing, so that means they will have a big trouble of cash flow, right? And that will be a going concern issue. Comparatively, for auditors, the responsibilities for auditor is that auditors should obtain sufficient appropriate evidence about the appropriateness of management use of going concern base of accounting, right? So management is the one preparing, assessing the going concern, and auditors is the one to obtain evidence about and evaluate the appropriateness of management assessment, right? So we are the one to judge whether they are doing it right, whether their assumption makes sense, right? And auditors should conclude on whether a material uncertainty exists about the entity's ability to continue as a going concern, right? So we should make that conclusion, and we report in accordance with ISA 570, because for going concern, there is a separate paragraph about going concern. So if you got a going concern issue, there is a very distinct paragraph in your audit report to describe the situation. So that would be the going concern. And for going concern, there's a lot of indicators. And so here's typical indicators for going concern. A net current liability, or an overall net liability. So that means the company doesn't have the right current assets to meet the current liability, right? So that is a tortured tortured balance sheet. So the structure is not right, and it implies that there could be a cash flow issue, right? Or the company suffered a accumulated loss in the past years, and the equity is a negative. So that makes an overall liability, right? Net liability. So that means the company is not running well and the operation is in danger, right? We're gonna we're going to look at the borrowing facility. So that would be a problem if the company has not agreed with the bank when it's close to expiry of the current agreement. So that means there is a question whether the current bank loan or the bank facility can be renewed in the next couple of months, right? And we would like to see if is there any defaulted loan agreement. So if you default on your debt, that is not a good sign, right? So that means the client is difficult to repay the loan, and they suffered a cash flow issue. Or there could be an unplanned sales of non-current asset, right? As we mentioned, if the financial situation goes as worse as you're gonna sell your non-current asset, then you get cash and then you repay your debt. So that means your future, the profitability of the future is you are sacrificing the future profit to meet the current liability, right? That would be a kind of suicide, right? Because you have no choice but to sell the ACCA, and that would sacrifice your future profit or operation. Right? That is a suicide, right? And missing tax payment. So if there is a tax issue, so that could result in fines or penalties, and that could be huge, right? And failure to pay the staff. So that would be a very bad sign for the liquidity, because if you cannot pay your staff, you cannot not pay the staff salary and wages, you're gonna bankrupt in the next month, right? There's no one work for you anymore because you don't pay your salary, right? So that would be another sign of going concern. And negative cash flow. So it is okay in the short term, you have a negative cash flow because of your working capital, but if you're gonna overtrade, so that means you have a huge revenue in the short term, and you don't have a favorable payment term. So that means your accounts receivable will occupying all your cash, right? So in this way, that is an overtrading, and overtrading will jeopardize your cash flow, right? And inability to obtain credit from suppliers, right? So part of the working capital, we take payment terms from suppliers, but in case there is any credit issue, or you have any cash flow issue, or you didn't pay in time in the past, your supplier will not offering you the credit term anymore. So that means they want cash. If you want material, and you're gonna pay in cash right now. So that would be another reason for the cash flow issue. And major technology changes. So maybe the new technology requires all the business to be online, or there's a new tech to replace the current products, right? You need to upgrade your product, and there is a substitute of your current goods. In this way, you have a very big issue of operation, and maybe your inventory is dead. So that would be another going concern. And legal claims and loss of key staff, because loss of key staff might result in an ability to trade. Maybe that staff will take away all your clients, all your customers, or that staff knows, it's the only one knows how to manufacture your goods. And over-reliance on a small number of products, staff, suppliers, or customers. If you have a single suppliers or a single customers, single customer, that means you're highly relied on him or on that supplier or customer. So in this case, if your only customer decide to not buying your goods, then you have a big issue, right? In customers ceasing to trade, so that means you will have an irrecoverable debt, a bad debt, and if the balance is pretty high, that means your cash flow will be jeopardized, right? And the emergency of the successful competitors, so that competitor will absorb all the sales opportunities in the market, and your revenue will goes down dramatically because of the successful competitor. So that will be a risk, right? So we should consider the Porter's 5 forces, although it's not required in our F8 examination, but that provided the angles, the ways to think about whether we have a going concern issue here, right? And if there's any uninsured catastrophe, a disaster, and in case that happened, so your client might suffer a big loss, and that would jeopardize their future operations. And there might be changes in laws and regulations. For example, if the cigarette is forbidden to be traded in the market, then that would be a huge problem of going concern, right? So it's these are the typical indicators for the going concern. But in reality, there's a lot of indicators. So as a mature CPA, you're gonna keep an eye on it, right? Be alert on the going concern. And so audit procedures for going concern would be the auditor should assess management evaluation of going concern. So we're gonna obtain the management's assessment, and we're gonna evaluate that assessment of going concern. And we should assess the same period that management have used in their assessment. So we're gonna independently assess that again. If it's less than 12 months, we're gonna ask the management to extend their assessment to 12 months, because that will be a minimum requirement for going concern. And we should consider whether management's assessment includes all relevant information. Right? So audit procedures to perform where there is a doubt over going concern. So that means we feel there is an issue of going concern. Then we should take further action to analyze and discuss the cash flow, the profit, and other relevant forecasts with the management. And this should include assessment of the reasonableness of the assumptions used to prepare the forecast, right? And we analyze and discuss the entity's latest available interim financial statement, because that would reflect the most updated financial situation, financial position of the client. And we review the terms of debentures and loan agreements and determine whether there is any breaches of the loan agreement. Because if there is any breaches of the loan agreement, you will be required to repay the loan immediately, right? So that would drive a cash flow problem. And we read the minutes of meetings for reference to financing difficulties. And we inquire of the entity's lawyer regarding the existence of litigation and claims. We confirm the existence, legality, and enforceability of arrangement to provide and maintain financial support with related and third parties, and assess the financial ability to such parties to provide additional funds. So we might have the responsibility to finance our related party, and maybe the related party have a responsibility to finance us. So we should look into that. We should confirm that. And we review events after the year end to identify those that either mitigate or otherwise affect the entity's ability to continue as a going concern. Legal case, for example, right? And we review the correspondence with customers for evidence of any disputes that might impact recoverability of debt and affect future sales. And we review the correspondence with suppliers for evidence of issues regarding payments that might impact the company's ability to obtain supplies or credit. And we review correspondence with the bank for indication that a bank loan or overdraft may be recalled. And we obtain written representative representation from management regarding its plans for future and how it plans to address the going concern issues, right? So they are the one, the management is the one has the responsibility to disclose the going concern issues identified to the auditors and assess their going concern position and giving and send the written representation to the auditors. So our audit procedures should focus on cash flows rather than profit, because this is a going concern. A company can still run without a profit, right? But they cannot run without cash. That would be our concern. So therefore, our procedures is to obtain evidence about the amount of cash that we're gonna receive and cash we're gonna pay out. So we only focus on the cash flow when we are evaluating the going concern issue. Okay? And for going concern, where there isn't any material uncertainty over the future of a company, so the directors should include disclosure in the financial statement. And a material uncertainty exists when the magnitude of its potential impact, likelihood of occurrence, is such that disclosure of the nature and implications of the uncertainty is necessary. Right? If it's necessary, then the management should disclose that. And in the disclosure, the management should explain that the principal events or conditions that cast significant doubt on the entity's ability to continue as a going concern, and management's plan to deal with them. So, in a word, the disclosure should explain what is going on and whether we can fix it, right? Very simple. So the company may be unable to realize its asset and discharge its liability in the normal course of business, right? So in the disclosure, you're gonna explain what is going wrong and whether we can fix it and how we're gonna fix it. Right? So whether the director have been unable to, where the directors have been unable to assess going concern in a usual way, so this fact should be disclosed. And so that means you're gonna say, I don't really know what's going to happen. We don't have the information about the next 12 months, and just say you don't know. But you cannot hide from the going concern issue. You should still disclose that even you are unable to assess, right? And whether the financial statements are prepared on a base rather than the going concern base, so the base used should be disclosed. So if the management use the going concern base, which is the efforts, then the base should be disclosed. Right? And if it's a breakup base, then definitely it should be clearly disclosed. And the reporting implications, the auditor should modify the audit opinion if the directors have not made adequate disclosure of any material uncertainty related to going concern, or if the director have not prepared the financial statement on appropriate basis, right? So they may not disclose the going concern, and they may not prepare the financial statement on the right base. And the auditor should issue a unmodified opinion with additional communications if the directors have appropriately disclosed the going concern uncertainty or prepared the financial statement on the breakup basis. Reporting implications in relation to going concern are covered in the next chapter. And so to evaluate the going concern, we should examine the cash forecast. And we examine the reasonableness of the assumptions which was used to prepare the cash flow forecast. And our procedure would be we agreeing the opening balance of the cash flow to the cash book. We consider how reasonable company forecasts have been in the past by comparing the past forecast with the past actual outcomes. So our assumption would be if the forecast in the past works, so that means it is highly possible it works in the future, right? Maybe the management is preparing it in the right way with the right assumptions. And we determine the assumptions that have been made in the preparation of the cash flow forecast. For example, if the company is operating in a poor economic climate, then we cannot expect a strong growth of sales, right? And we agree the timing of receipts from realization of receivable and payments to suppliers with credit period and previous trade receivable and payment and payables payment period. So that will be the working capital days, right? And we examine the company's detailed budget for the forecast period and discuss any specific plans with the directors. And we examine the assessment of the non-current assets required to meet production needs, because the CapEx burns cash, right? So we would like to examine that. And for acquisitions of buildings, we will agree the timing and amount of cash flow and to the expected completion date. So that will be your CIP, right? And consider the adequacy of the increased working capital and compare actual performance in the most recent management accounts to the forecast figures. And so we will be comfortable if the forecast works well so far. And we recalculate the cash flow forecast balance to verify arithmetical accuracy, and we expect the board minutes for any other relevant issues which should be included within the forecast. So this is kind of management accounting, but as an auditor, we should evaluate whether the management is doing the forecast in the right way, because it would be very easy for the management to overestimate the cash flow position by increase the revenue a little bit, by decrease different kind of cost and expense a little bit, and delay our payment and push the payment from suppliers. And the cash flow would be goes way up by manipulating that. So as an auditor, we should be alert on the forecast, right? It can be very judgmental. And so going concern indicators we have an example here, and we were requested to use our information provided to describe the indicators. So here, a major customer has been placed to administration. So that means we would suffer a big loss of future revenue and outstanding debt is unlikely to be repaid. And sales director left. So for the key stuff, it might impact our future sales. And sales director is suing. So for the lawsuit, we might get paid expensive legal costs and reputations, and it's difficult to might be difficult to recruit a suitable replacement. And the company is seeking a new fund through IPO. So that means the company does not obtain new funding through a listing. Alternative finance will need to be obtained in order to continue operate. So we're going to evaluate the potential of the client on their financing resources. So if they have a strong financing resources and they have a low gearing, so that would be very comfortable for a cash flow evaluation. And the company is operating close to its overdraft limit, right? The company is running out of the resource. So it is heavily depend on the short-term source. So that would be a going concern issue. And the cash flow forecast shows a negative monthly cash flow for the next 12 months, right? Looks bad. And the number of suppliers have been paid late, looks bad, right? And the loan facility is secured in part on the refurbished assembly line, which has broken down. So the bank might withdraw the loan facility if the asset secured is significantly impaired, because you pledged your asset to get the loan, and now your asset doesn't it's not in a good condition. It's impaired. So at least as a bank, they don't really want to loan you that much anymore, right? So you're going to look for alternative finance. So the assembly line broke down during January. So that means the orders from your clients, from your customers cannot be fulfilled, and your reputation and your market might lost. Right? And a fire at the premise of the third-party warehouse, and that inventory is half of your inventory balance. So that means you cannot ship to your customers in time, and you may lose your reputation, lose your market, right? And you may, if it's not covered by insurance, your trouble is bigger, right? So another example for going concern, we were required to define a going concern and the director's responsibilities, and state the audit procedures for the going concern, and audit procedures and actions that the auditor may take where the auditor has decided that the company is unlikely to be a going concern. So going concern means that the entity will continue in operational existence for the foreseeable future without the intention or the necessity of liquidation and otherwise ceasing trade. So if you cannot remember all the definitions, just describe your understanding of going concern. So the principle would be the company should be existing in the next 12 months, right? And auditor's responsibility, director's responsibility, audit process, and if the going concern is highly uncertain, then we should take a further audit procedures, like we discuss the situation again with auditors, and whether additional disclosures or whether you should use the breakup basis. And we explain to the directors that if additional disclosure or restatement is not made, then auditor will have to modify the audit opinion. And we consider implications for the auditor's report if and we may add a paragraph headed material uncertainty related to going concern. And where the directors do not make adequate disclosure of the going concern situation, they modify the audit opinion due to the misstatement, right? And modification will be expect for qualification or an adverse opinion if the going concern is a pervasive. And the basis for opinion section will be changed to a basis for adverse opinion or basis for qualified opinion to explain the reason for the modification, right? And before we sign off our audit report, we're gonna have an overall review, and we are so the review is to ensure that the compliance with accounting standards and accounting policies are sufficiently disclosed, and they adequately reflect the information and explanations, right? So we should have that checklist on our final review, the overall review, right? We should have that checklist, and we should perform analytical procedures, and it is to analyze and to see whether our audit result is the same as our understanding of that entity, right? Because if our understanding of the entity is that they have a pretty high risk, and but our audit result is that and the customer is fine, so that implies there is something wrong, or maybe we still need to take a further look on those high risky area, right? So we're gonna perform that analytical procedures, and we review the aggregate of the uncorrected misstatement to assess whether a material misstatement arose. So the purpose of reviewing procedures, that is part of our quality control, right? So we're gonna take a look back and see whether we get the right conclusions as we expected. Is there anything missed or any misunderstanding? So the audit work was performed in accordance with professional standards, and if there's any significant matter, then we would like to make sure it was appropriately resolved. And there is a need to revise the nature, timing, and extent if we still need to take further procedures. And the audit evidence gathered by the team is sufficient and appropriate. So we're going to take a final review and see if there is any evidence missing, or is there still anything we should do. So the auditor should ensure that the initial assessment made at the start of the audit are still valid in light of the information gathered during the audit. So maybe in the very beginning of the engagement, we think this is a good client, and the inherent risk and the control risk is low. However, after the audit process, the risk is not as good as we thought. So in that way, we should change our original audit strategy and planning by revise the nature, timing, and extent to reflect the different level of risk, right? So that would be a final review, an overall review, which is very important to the engagement. And we're going to evaluate the misstatement, which is ISA 450. We by accumulating a record of all identified misstatements, consider if the existence of such misstatements indicate that maybe other misstatement exists, and if these are material, so we should consider if the audit strategy and plan should be revised, and we communicate all accumulated misstatement to an appropriate level of management on a timely basis and require that misstatement to be adjusted or corrected. And if management refuses to correct, then we're gonna listen to their reasons for the refusal and take those into account when we are considering the FX, whether the FS are free from material misstatement. So for the uncorrected misstatement, we should reassess the materiality to determine whether it is still appropriate in the circumstances as the level of risk might be deemed higher because the management refused to correct the misstatement. If they refuse, that means the risk is high, and that means we should use a lower materiality because the risk is not as good as we thought. So we should change our audit strategy, plan, the NET, right? And determine whether the uncorrected misstatements, either individually or aggregately, are material to the financial statement as a whole, and considering both the size and nature of the misstatement and the effect of misstatement related to prior periods. So if a single misstatement is considered material, it cannot offset by other misstatement, right? So an individual is an individual. You should adjust or correct that individual misstatement. And if for those unmaterial misstatement, you can add them together. It can be positive and negative, but together the overall effect could be fine, right? So that would be the difference. For individual misstatement, you have to correct that misstatement. For the aggregate misstatement, you're gonna evaluate the overall amount, the overall materiality, right? So then we request written representation from management and those charged with governance that they believe the effect of uncorrected misstatement are immaterial, right? And we communicate those misstatements to those charged with governance. So here's an example. This is number one is an individual misstatement. This is as huge as 211,000. So for this individual misstatement, you're gonna ask the management to correct that misstatement by writing off those irrecoverable debt. And the rest of three cases are immaterial, but together we should calculate the overall impact, which is 80,000. As you can see, there is a positive which increased the expense, and there is a negative which decreased that expense. But overall, it's 80,000, and 80,000 represent 7.6% of profit before tax, and that would make it material. And so So this misstatement will need to be adjusted because overall the total effect is material for all those unadjusted misstatement. Right? This is how we you may have a lot of AJEs or RJEs at the very last stage of your audit, and you're gonna still talk to the management, and before that you should decide which has to be corrected and which is okay, which is immaterial. But you're gonna need to add all those immaterial adjustments together and see whether the aggregative effect is material, right? And written representations. So this is interesting because for ISA 580, it's about the written representations. Right? In my opinion, part of the reason we get written representations from the management is to make sure that they understand their responsibilities, and they claim that they have disclosed, they have that responsibilities, and they have given you the access to all the informations. There's no hiding, right? But and sometimes a written representations can be the only evidence we get for those estimations, for those judgment related accounts, right? So they have, so with that written representations, they would claim that they have fulfilled their responsibilities for preparing the FS, and they're gonna support to support other audit evidence. But if other evidence is relevant to the financial statement, if deemed necessary by the audit or required by specific ISAs, then they're gonna provide it. And also they have provided the auditor with all relevant information. All transaction has been recorded and reflected. So those are the written representations about. So they should claim those items to the auditors. So representations to support other audit evidence may be appropriate where more reliable form of evidence are not available, especially for those accounts highly relied on the judgment or knowledge, right, restricted to the management or intentions, right? So examples would be whether the selection and application of accounting policy are appropriate, why they are selecting that accounting policy, and whether the following matters have to be measured, presented, and disclosed in accordance with relevant financial reporting framework. Say, the plans or intentions, liabilities, the controls and title and aspects of laws, regulations, and contractual agreements, right? For those matters, it should be communicated by the written representations. And the directors have communicated all deficiencies in internal control to auditor, and specific assertions about classes of transactions, accounts balance, and disclosures requiring management judgment. So written representations cannot be a substitute for more reliable evidence. Right? It is a client-generated evidence, so it is not so reliable. But sometimes we're gonna need that. Right? But if you have a better choice, you have to get the more reliable evidence, right? And you compare that evidence with the written representations and see whether they are saying the same thing, right? They are correct. So the written representations should only be sought to support other audit evidence. Right? So it's a supporting evidence, should not be the main evidence, right? Because it's eventually it's generated by your client, not a third-party evidence. So it's not as strong as other evidence. So process for obtaining a written presentation would be, first of all, the auditor should draft the wordings of the written representations and print it on client-headed papers addressed to the auditor and signed by the client. So the content and format should be from the auditor, but the customer, your client, is the one to confirm that it is correct and sign off on it. So the letter must be signed by appropriate senior member, say the CFO or CEO, who can represent the company, right? And the date of the written representation letter should be same as the date of financial statements that are authorized, which is the preparation date by the management, and it should be obtained and signed before the auditor's report is finalized. So for the reliability of the written representations, it is a client generated, so as we mentioned, and it might be subject to bias. An auditor must consider the reliability of written representations in terms of the concerns about the competence, integrity, ethical values, or diligence of the management, and the inconsistency of other forms of evidence. So if there is an insistence with other form of evidence, that means the management could be lying, right? So we should take steps if the written representations are inconsistent with other evidence. So we're going to consider the reliability of representation in general. We will consider the initial risk assessment. We consider the need to perform further audit procedures. So that means your client is lying to you. So the risk is much higher than you thought, right? So we should pay attention to the inconsistent with other evidence. Right? If your client is lying, then you should reevaluate the risk, and you should take further procedures. In our examinations, obtaining a written representations, we're gonna explain why we are obtaining the representation for. For example, we obtain that written representation to confirm the completeness of directors, to confirm the bonus. So there must be reason to ask for that document. And if there are concerns about the competence and integrity, ethical value, or due diligence, that means if you have the concerns that your client is lying to you, the auditor must consider whether the engagement can be conducted effectively. Right? So if your client is lying to you all the way, that means the risk is it's pretty high. So you might reconsider your engagement, right? And if they conclude that it cannot, then they should withdraw from that engagement. And if they cannot withdraw, they should consider the impact on the auditor's report. And maybe they would eventually it will be a disclaimer of opinion, because it's a limitation of scope, And so steps of management refuse to provide written representations. Sometimes the management might refuse to give you that. So although possibly unreliable, a written representation are still a necessary and important source of evidence, because at least it is an attitude, it is a claim, it is a confession of the management, right? So, but if they refuse to give you that written representations, you should discuss the matter with management to understand why they are refusing, and you're gonna reevaluate the integrity of the management, because there might be something wrong, and especially this may have on reliability of other representations, and you might consider the implication for auditor's report. And so for audit report, we might issue a disclaimer of opinion if the auditor concludes that there is sufficient doubt about the integrity of management, which means the written representations are not reliable, or management does not provide the written representations required in relation to confirming their responsibility to prepare the AFS and to provide the auditor with information and confirming completeness of transactions. So that means we're going to issue a disclaimer of opinion, right? Because of the management's refusal to provide a written representations. So here's an example, mention 6 items that should be included in the written representations, and 3 reasons why auditors obtain written representations. So here are items to be included in the written representation letter. All books, records, relevant information have been available. So we are prepared our FS according to the framework, IFRS. All transactions are recorded, and there's if there's any unrecorded, uncorrected misstatement, they are immaterial, and there's no non-compliance, and we're going to continue to trade. There's no going concern issue, and we don't have a plan to alter the carrying value or classification of assets or liability, and we don't have a plan to dispose any NCA, and all subsequent event has been disclosed, and no irregularities. Right? So those are the items that a written representation letter should cover. And the reasons we need that is because it is a formal confirmation by the management of their responsibility. They should confess. They should take the role of the responsibility. And it is to support other evidence. And it is requested by ACCA 580. Right? And this is what a written representation looks like. Right? The title, date, and they're going to confirm financial statement related items. They're going to confirm the information provided, and it's signed off by the finance director, managing director, right, by the senior level of management. So this is the completion stage. We're going to review, and we're going to look back on from those perspectives, such as the subsequent events and the individual or aggressive of the misstatements, the going concern issue, analytical procedures, and we're going to review, look back on our audit plan, right, the work down, and we're going to take the written representations from the management. So before we can sign off our audit report, these are the procedures or the steps we should take to make sure we have a good quality of the audit report.